we are convinced that inflation will last much longer than the market consensus is anticipating right now. And that's the reason why you should load your portfolio as far as possible, as far as the regulator or your restrictions allow you, with real assets. If a banking system or a currency system is getting into danger zone, then the gold price is reacting to the upside. And that's the reason we hold it.
Welcome viewers to Assay TV. We're speaking with investment strategist and regular macro commentator Philipp Vorndran, who heads the investment strategy at Flossbach von Storch, one of the leading independent asset managers in Germany. Welcome, Philipp.
Hi, how are you?
I'm very good, thanks. And thanks for taking time to speak with us about this interesting macroeconomic scenario that we find ourselves in, very challenging at the moment. And I perhaps wanted to start with getting a view from your perspective as an investment strategist. How do you interpret this perfect storm of inflation and energy crisis on top of war and various other climate issues, creating real macro headwinds for the global economy at the moment?
I think to some extent, the best description is the genie is out of the bottle. And it won't be inflation for just a short period of time. Inflation is here to stay because it's not only driven by all the issues we are very well aware of, energy problems, the war, Russia, Ukraine, some problems with supply and demands here and there. This certainly is a trigger. But we have a lot of very structural issues, which at least in Europe and maybe globally will lead to a higher inflation level than the one most investors have been used to over the course of the last 20 to 30 years. It's certainly driven by momentum in deglobalization. We all are aware of what's happening around the power struggle between the US and China. We try to rearrange our supply structures here that will lead to perfect de-escalation. And I think a major driver of the low inflation rates we had been used for the last years was globalization and scaling up the economy. Second driver is all the debates about a less carbonized world to save our planet. And this is costly. This will lead to massive shifts in our energy supply. That's necessary, I think, but it's costly too. And most people only now start to realize that this will have an impact to their consume balance sheets. And thirdly, I think that's predominantly an issue here in Europe. It's the demography. We have very, very weak birth rates. The new generations in terms of headcount are much smaller than the one which are retiring at the moment. And this will cause some problems and especially some better negotiation power of the workforce and inflation on the second round effect level, which we are absolutely able to observe right now. I think these three structural issues will stay and will lead to higher inflation rates for the next decade at least.
For the next decade, wow, yes. It's certainly a difficult picture. I wanted to ask, within your role as a strategist and how you advise your various funds within the firm, how do you think institutional investors are reacting at the moment? Is the strategy pivoting to a sort of hedging approach? Is it a rush for safe haven assets? Or are there still opportunities out there where there are pockets of growth, depending on the sector? For instance, you mentioned the decarbonization trend. It doesn't seem like that's ending. Obviously, it's very expensive, but if we look at the US, they're piling a lot of money into that from the infrastructure side of things, from the new Inflation Reduction Bill that was launched, for instance. Germany is certainly doing a lot in terms of ramping up investment into alternative energy, renewable energy, for instance.
Yeah, that was quite a lengthy question. I hope I have still in mind what the beginning of it was. Yes. I remember the best word flight into security or safety. I think the most stupid investment decision these days, at least if you are a long-term investor, would just fly to safety or fly to cash and nominal assets. We are convinced that inflation will last much longer than the market consensus is anticipating right now. And that's the reason why you should load your portfolio as far as possible, as far as the regulator or your restrictions allow you, with real assets. Because these are the only asset classes which are able to protect your real wealth. We all are aware where the interest rates are of safety investments. The Bund, 10-year Bund is at 1.3. The 10-year Treasury is slightly above 3%. That's not a very useful long-term investment with inflation rates between 7 and 9%. Even if you don't assume that 7 to 9% level to stay for the next years, and I rather would expect something between 4 and 5% per annum. But these two investments are investment flirts, maybe from time to time, but not a structural part of a decent portfolio. A decent portfolio is looking for real assets and on top of that, a very strong quality bias. Quality defined by the possibility to roll over the inflation of your cost structures. If you are a company who has more or less a monopoly in the product you are producing or the quality of product you are producing, you are able to set prices. And these companies can protect their earnings and the earnings growth even in such inflationary and such problematic geopolitical periods. If you are a price taker, then you only can try to improve your cost management, which with most companies is already at a quite decent level. So no flight into security and no flight into safety. Handpick your real investments and stay with them. Of course, you have to have some leeway in terms of nerves and acceptance of risk. But if you have that leeway, then these are the asset classes which are able to generate you at least a real return of zero, which will be after cost and after taxes quite a difficult thing to achieve anyway.
Excellent. Okay, that's very good, and thanks for explaining in depth there. Let's look at where gold and maybe precious metals might sit within that. Obviously, historically, they've been sort of a hedge or a flight to security, which you're saying is not necessarily the case right now. But are there attributes of the precious metals and gold that can sit in the portfolio now? And also, why did we get this strange reaction where, with a war and a crisis, gold price actually dropped? Conventional wisdom would assume that the price should be going through the roof right now.
Yeah, the only precious metal we are using for our asset allocation is gold, and wherever and whenever possible, physical gold. For us, it's not a flight to safety investment. It's just an insurance against the known and unknown risks of our financial system. And on top of that, obviously, a decent medium and long-term inflation protector. These are the two relevant structures and reasons why we hold gold. We don't think it's a hedge against geopolitical risks. Gold is not reacting at an invasion of Russia, of Ukraine by Russia. Gold is not reacting if political turbulences like the Brexit appear, but if a banking system or a currency system is getting into danger zone, then the gold price is reacting to the upside. And that's the reason we hold it, and we have tried to measure the inflation protection capability of gold since the 1970s, when the bounding of gold to the US dollar was ended. And it's doing a decent job, not month over month, not quarter over quarter, not even year over year. But if you look into 10-year periods, then the difference between the performance of gold and the performance of the inflation rate is plus minus 1.5%, which I think is quite decent, especially if you are afraid above a more aggressive hike in inflation than the one I'm expecting.
Yep, very interesting. And do you recommend any particular weightings towards it, as sort of increasing that now, or is it a case of just something that you need to always hold in a portfolio?
Yeah, it's to some extent relevant how real asset driven your portfolio is. If you hold a performance of 100% quality equity, then the need for gold is less dramatic than if you hold an 100% fixed income portfolio. With real assets, you have some kind of inflation protection, given that you have real assets, which obviously are not as liquid and as homogeneous as gold is, but they provide quite a decent inflation protection already by themselves. If you have only government bonds, then the risks of an instability in the financial system and inflation is not covered by the return which you are able to achieve. Here, your allocation should be higher. I think between 5 and 10% of your portfolio, that's quite a decent gold position, which we think is big enough to make the difference and not too big to generate a cluster risk.
Yeah, certainly. Okay, great. Well, can you give us some examples of the other real assets that you feature in your portfolios, or that you think allocation is important for now? Is it just infrastructure, or is it other forms of property?
Yeah, first of all, it's your own home. And this home, hopefully not leveraged to a major extent. Right. That's for us the basis of every single asset allocation. I know that sounds a bit ridiculous to institutional investors and to wealthy families, but maybe some private investors watch our video too. So that's the starting point. If you already have this portion, then the real estate side is perfectly covered for most of the private investors. Then I would argue focus on quality equities and maybe quality and regional diversified REITs, if you think it makes sense to add another component on the real estate side, but do it liquid, do it global, and not just all around the tower of your church, which quite often is the case, that the real estate fortune is quite concentrated to a country or a region. So equities, some real estate, physical gold, and if you are a specialist in given field. Maybe you are an art collector by heart, or you love old timers or watches, then this could prove to be a useful investment too, but only if you are a real insider. But because if you are not, then you always will perform below the market potential. So the easiest, I think Warren Buffett is one who proves that this makes a lot of sense, is to build a decent portfolio of global equities and sit on these quality equities for the next 40, 50 years to really enjoy the compounding effect.
Yeah. Okay, that makes sense. Great. I wanted to come back to the decarbonization theme that you mentioned was one of the driving forces of the sort of cheap money period and the sensational spend that we've had in the last sort of 20 years, or certainly post GFC. How do you see this continuing to influence the investment landscape now? And it's very much part of the ESG piece, I think, where funds and businesses are having to be very conscious about the carbon output of their investments, whether it's scope 1, 2, or 3 emission standards. Do you think that's going to put the brakes on things, or is that going to accelerate more capital into various sectors?
Yeah, if you had managed your company in a family-driven manner, then this wouldn't be any news to you. If you manage your company like your family corporation, you always would have performed well in how to handle your workforce, in how to handle the local environment, and of course, how to react with your local officials, because if you wouldn't have done that way, you would be blamed. And your neighbor would come across and argue, well, Philip, I'm not going to buy any products of your company because you misbehaved. And the problem is that a lot of listed companies in the past haven't been managed that way. They had been managed in the search to optimize the return for the next 3 to 5 years, the period the CEO or CFO in charge has a contract still. And this mismatch of 3 to 5 years versus eternity led to the problems we had on environmental and social factors. So in general, I would argue it's a good idea to bring that into sync again and to have management more and more behave like if the company would be their own. The problem is all the administration involved with that. That is generating costs, which not necessarily would be here if management would have done better before, but we have the same in the financial sector. We have misbehaved, the regulator stepped in, and now we have additional costs for having misbehaved in the past. So ESG, especially G, but also S and E are very important, and I'm convinced that a medium term that is going to lead to better managed companies.
Yep, fantastic. My last question, I just wanted to point to the strength of the US dollar throughout this turbulent period and what your views were around the US economy being sort of viewed maybe as a safer market for equities investments, and how you see the dollar strength longer term. Is it a good thing at the moment? Certainly hurting a lot of other economies.
First of all, it's extremely difficult to make any forecasts on currencies, sure. But I think everybody knows that. However, having said that, there are a lot of structural reasons why the currency pair is trading the way it's trading right now. First of all, we have the interest rate differential. Look, 3% for the 10-year US Treasury here and 1.3 for the bond. If you are an investor coming from the moon and only put your money just based on the returns you are able to expect by the coupon, then you tend rather in favor of the US dollar or the US Treasury than the bond. That's just math. There are structural reasons. I think the US is just an economy which still admires entrepreneurs. Everybody wants to be an entrepreneur, and Elon Musk is a hero there. Whereas here in Europe, it's rather a person you mistrust. And maybe Elon Musk is a bad example, but the way people go to Omaha for the Berkshire Hathaway general meeting indicates that they are interested. Nobody admires any founder of an economy here in Germany. It's more that they are looked upon with a lot of skepticism, whether they have treated their workforce bad or whether they have tried to avoid taxes or things like that. That's a very important structural reason. Then we have the demographics, which are important for the growth perspective of an economy. The potential growth rate is driven by the growth of the labor force. And if you have a reproduction rate the way we have it in continental Europe, and you have one like the one in the US, there's a major gap. This is clearly in favor of the US. And I would argue all the crises we are in right now indicate how dependent Europe is from countries where the leadership is not necessarily driven by democratic process. Neither in Russia nor in China, and the dependency here in Europe to these two regimes and countries is quite a bit larger than in the US. So in general, I think there are decent reasons why the US dollar is that strong. It's not only vis-a-vis the euro, it's against the yen more or less the same way. I would argue it's a strength of the US dollar rather than the weakness of the euro.
Yep, certainly. Excellent. Well, look, Philipp, fantastic. Thank you so much. That's taking us to our allotted time, but there we have it, the real assets, the gold, the quality equities, certainly a lot for investors to pick over and to get some ideas from. And really, thank you very much for sharing some insights to your approach and your strategies for the fund.
It was a pleasure.
Thank you.